CNBC TV 18, celebrating 15 years of leadership.
Hello and welcome to Street Signs. This is an important phase for the markets. We have just a fortnight to go for the big bang Modi government budget. And at the same time, although expectations are high as we run into the budget, earnings recovery has not panned out at all. And that's making the market a bit nervous. To discuss all this and more, we have a power-packed lineup. Joining us is Jyotivardhan Jaipuria of Bank of America Merrill Lynch. In a bit, we'll have Jahangir Aziz of JP Morgan as well. And Udayan Mukherjee is also with me on the show. Hi, Udayan. Welcome to Street Signs. How do you approach this phase in the market now ahead of the big budget?
Things have been very pedestrian this quarter, or quite pedestrian this quarter. In most of the clusters focused on the domestic economy, whether it's banking, whether it's infrastructure, pockets of auto, and even consumers, earnings have disappointed. So I think investors are slowly coming around to the view, or accepting the view, that it will take longer than they had penciled in earlier for earnings recovery to catch up. So there is hope because of the important event which is out 3 weeks, the union budget, and if that comes out to be a very strong document, then the market can shed fears about earnings for the moment, and you could see some more valuation expansion. But left to its own, all other things being equal, I think the market may well be just a little ahead of itself, and in other circumstances, without the budget, it might have corrected a bit more. So if the budget is strong, maybe the market's floor is set close to where we are right now. But if the budget is a bit of a non-event for the market, not too strong, not too bad, then I think chances are that we might see a bit of a correction, just valuations compressing a little bit in the light of earnings taking longer to catch up.
So when you say have patience, so then what does that mean for a retail investor? Do you buy at this point, or do you just wait for the budget to pan out and, other issues like higher supply hitting the market, etc., all of that to pan out before taking your next investment call?
I think for investors, Sonia, 5-6% difference in price or 5-6% difference in the Nifty level should not frankly make a very big difference if you do believe that we have entered a 2, 3 or 3, 4 year kind of a cycle where earnings will slowly catch up and accelerate and markets will remain buoyant. If that is your premise, then 5-6% or 6-7% difference in prices should not actually make a very material difference to your opinion on how you should be approaching the market. I think this remains a market where you need to be patient and hold. You could buy some of the declines as and when they come about, but broadly remain invested and not to panic for every 4-5% fall in prices. I think we've seen that while retail investors have come back over the last 6-9 months, because probably of their anchoring or memory of the last 5-6 years, they tend to panic too easily. Every 4-5% fall in the market is met with some kind of opinion that this is the end, this has become a sell on rally market. I don't think any of that has happened. It's true that earnings are still quite disappointing and lukewarm, which means that from time to time you will get these bouts of corrections. One needs to buy them and remain patient, because by the end of this year, maybe earnings will be showing us a different picture. At least that's what I hope.
Yes, that's the hope that the market has. So let's do one thing. Let's get in a perspective now. We have Jyotivardhan Jaipuria, Head of Research at Bank of America Merrill Lynch, who joins in. Jyoti, hi. Welcome to Street Signs. Earnings will catch up, but the fact is that they have not done already. And in fact, the earnings have been weak this quarter for so many sectors like banks. Could that hinder the upside performance for this market?
Yeah, to some extent, that is what most of us were expecting. So like before the earnings season started, we had warned that this earnings season is probably going to be the worst in the last 6 quarters. Earnings are going to be like low single digit in terms of aggregate earnings growth. So to that extent, it's what, a lot of us had factored in. My view is that the markets had a rally last year, and we are in a phase of consolidation in the market. We probably, spend the next 3-4 months more or less doing nothing, just being in a very narrow band before we get ready for the next leg of the market.
Hi, Jyoti. What's the downside to this market after looking at this earnings? Do you think the market should give up some ground, or do you think it has the strength to hold on to current valuations?
Udin, my view is that markets probably will end up being largely range bound, so we can see 5-7% correction, and a lot of it may be driven more by global than really what happens in India. Because though earnings per se don't look very good, like if you just step back and think of India relative to the rest of the world, earnings are not looking good anywhere in the world. There are not too many countries which are in a phase where you think, okay, the earnings are probably getting close to a bottom and we can see uptick. Secondly, there are not so many countries where, monetary policy is clearly going to get eased, interest rates are going to come down. So to that extent, people are willing to be more patient and they're looking at every dip as a buying opportunity. But I'm sure we can get like a 5-7% correction in the market at any point of time. A bit of negative news, you could see that sort of pullback coming.
What about banks? I mean, that's the one sector everybody's talking about. It's been the standout performer last year, and all of a sudden stocks have corrected 8-10%, earnings have not been great, and there's a bit of a spotlight on the sector, public sector and even private after ICICI this quarter. What are you telling your clients to do there?
So we still like the banks, and I think banks is a sector which will do well this year and see the next 3 years also. But what we had done at the beginning of this year is cut a bit of our overweight on banks, and basically there were two reasons. One is the stocks had done very well, so I said the margin for error is very low in them. There will be time before they start to recover again. So NPLs will recover, but NPLs are probably going to take 6 to 12 months before they recover. And second is, it is by far the most overrun sector for foreigners. So, foreigners are massively overrun the banks. So that's, both of these mean margin for error is very low. The stocks have done so well that, even if after they correct 8-10%, for anybody who bought it like somewhere last year, he just thinks, okay, I've lost a bit of money, just corrected a bit. So nobody is really panicking about it. But again, so, it's typical of the market really that things have run up a lot. You now need a bit of consolidation phase because, the actual recovery will take time to come. Whereas, the earnings are, or the valuations are pricing in some sort of recovery already.
What about the interest rate scenario, Jyoti? Because the rally that we saw from the 15th of January, when that surprise cut came in, was purely courtesy the move by the RBI. How many rate cuts are you expecting up until the end of the year? And will it really help in terms of earnings and the overall economy? Because none of it has been transmitted yet to the system.
Yeah, so, we think that there will be like 50 basis point rate cut this year, another 50 next year. So basically 100 more. It could be, 100, 125. So somewhere in that range, I think most of the consensus is like looking at between 100 to 150 basis points of further rate cuts. Typically, if we go into history, it takes, 3 to 4 quarters after the first rate cut before you actually see signs of the economy starting to change. So if you, let's say, take auto demand, truck demand or things like that, it's like 3 to 4 quarters after the first rate cut that you see volume starting to pick up. At the same time, the stocks probably start picking up much earlier. Stocks, somewhere along the way start picking up because they start anticipating that there's going to be a change in volume. So that's why, the economic numbers are going to change, but they'll change probably closer to the end of the year. The market typically tends to anticipate that, and I think the market from last year has been anticipating a recovery. It played for that recovery, and then we get into a phase where the markets do nothing much. They remain range bound for 6-9 months till they see more visible signs of earnings come up. So this phase is nothing different from any of the old cycles. You go back to 2002, go back to the 92-94 phase. We've seen this sort of phase happening where markets have that first rally, which is pure re-rating. And then, there's a lag and it's a range-bound phase where markets wait for earnings to start picking up again.
Okay, fair enough. I was just going through one of your reports in which you suggest that you're overweight on the oil and gas space. We just heard that there could be a new subsidy sharing formula in place where the burden for, upstream like ONGC could be much lower going ahead. Do you prefer the upstream space, or would you still be interested in some of the oil marketing companies, etc.?
So we've been preferring the downstream, the oil marketing companies, and the logic for that is, whatever happens and whatever they change with the subsidy formula, the chances are that for the downstream at least the margins will be much higher than what they've been in the past. With the upstream, the risk is, the subsidy number comes down, but your core product is oil, and if, the oil price which you sell comes down a lot, then you start struggling on what am I buying that stock for. So that's the reason we've been preferring the downstream.
What about infra, Jyoti? But this time too, numbers from companies like Crompton, Alstom did not look great. Do you think investors will need to be patient? Do you see meaningful corrections here, or do you see consolidation and then a takeoff towards the end of the year, even in infra and capex related sectors?
So, my view is infra is like a late cycle sector. It will do well probably over 3 years, but we've not been very excited about it for, this year. We have a very, very minor, we are like neutralish to very slightly overweight. And the whole logic is this is a sector you have to keep a track on. Probably, you really want to be overweight this sector a year later, maybe towards the end of the year is when you want to really start playing infra. Because, the whole infra cycle is going to take like at least 18 months before it starts to pick up. So, from an investor point of view, if you get sharp corrections in them because results over the next 2-3 quarters is not going to be great, buy them and, buy them with the thing that, okay, I'm buying this because I think, 2 years, 3 years later, this will do well. But I don't think in the next 3-4 months, 6 months, there's going to be any great positive news on the infra space.
Stay on, Jyoti. We'll come back with more questions for you. We'll slip into a break. When we come back, we'll have more questions for Jyoti Jaipuria. Jahangir Aziz will also be with us. We're back in a minute.
CNBC TV 18, celebrating 15 years of leadership.